Us now with his insights on the energy markets, as well as some insights from his portfolio in commercial real estate and the restaurant industry. Ray Washburne, chairman of Sunoco LP, vice chairman of Gillen Capital. Good to have you here in person.
Good, thank you.
For the first time, we were saying, we obviously started this long-running conversation back in the pandemic to get a sense from you on the consumer.
Right.
And let's start there as well. Ray, what are you seeing in terms of prices at the pump, both here? I know you also have some exposure, I think, in Europe as well. But,
yes. Yeah.
In terms of gas prices and demand and whether people are pulling back at all?
Sure. Well, as far as demand goes, it's surprisingly hasn't gone down. It's up, actually ticked up just a little bit. And as you know, Sunoco, we're the largest independent seller of gasoline in the United States, 15 billion gallons a year. So we have pretty good exposure to everything. But the things we look at are supply. There's still a 20 to 21 day supply in terminals, which is very, very important, as well as refineries are still running at about 92%. So as far as the United States does domestically, things are fine. It's just the price that's gone up. But if you look back at price right now is around $3.80 a gallon. If you go back to when I got my driver's license in 1976, the average price was 56 cents a gallon. I was driving a 1969 Firebird convertible, getting about 8 miles a gallon. Today, cars are around 35 to 40 miles a gallon. Gas prices, inflation adjusted, has just kept track with inflation over all these years. Now, in the last month, we have had a bump up, but the American consumer is getting 4 times as much mileage out of a gallon as gas as they were going when I got mine.
Right. One reason why, as a percentage of their overall budget, as we were just talking about, right, it is far lower than it was during that period you're describing. Absolutely.
And we're seeing, and a lot of that translates, I'm very big in the restaurant business, as you know, and you know, you look at restaurant sales, and they've been flat. They've been down about 1% or so. But what's interesting in the restaurant business, so much of our business has shifted from in-house dining, which to go used to be around 5-6%. Industry right now, it's over 20% because of DoorDash and Uber Eats and things like that. So that's been an interesting translation since the pandemic on that happening. But we're looking at, we just haven't seen the consumer, and I don't know if that's a hangover, frankly, from the pandemic, where people are like, I'm still going to go out, I'm still going to enjoy life, and they're still going out.
I mean, you've got pretty interesting exposure, right? Highland Park, obviously, you've had high end as well.
Absolutely,
so
yeah.
Across the board, is there anywhere you're seeing weakness or something you're concerned about?
And the high end shopper in because we're the kind of the peak, we haven't seen any correlation or correction there at all. I mean, sales are very, very strong in the United States. I'm not speaking to luxury in China or other places. In the United States, things have been fine. The casual dining sector, again, is down about 1% or so, but nothing alarming at all. We've had no issue with labor. If anything, we have too much labor in the United States right now.
Really? Because I remember a time when obviously labor was a concern for you.
People are coming out of college and not getting jobs. We've had no issue in that. Our commodity prices are fine, except for beef. It's the only thing we had an issue with. Other than that, it's a pretty stable economy for us right now in the restaurant business.
I was going to ask about inflation, because we were also having a debate. So strong consumer, but we were having a debate about whether the higher oil and gas prices would feed into underlying inflation. And are you seeing it pop up anywhere else?
Well, oil and utility cost, electric costs, I mean, that for everyone has skyrocketed. And so, but our restaurants, things like natural gas, the United States has so much natural gas. You know, most restaurants have gas stoves and things like that. And natural gas prices haven't gone anywhere. They've pretty much stayed pretty flat through all this.
So pretty benign. Pretty
benign. Now, you look in Europe, okay, because we do have European operations.
Yes.
The problem in Europe is 80% of diesel in Europe goes through the Strait. 80%. The United States, all ours now is domestically produced. So Europe, Asia right now, like Vietnam, they've canceled domestic flights. Jet fuel in Asia is starting to have a ripple effect back through Europe. But diesel trucks, that's how commerce is delivered, is through trucks and through diesel. And so Europe is going to be the next shoe to drop if this extends too much. The great thing in the United States, we are energy independent.
Yes.
Totally energy independent from the rest of the world. Totally different from when I got my driver's license in 1976, you had lines down the street. We have an incredibly efficient distribution network in the United States, from the refineries to the midstream, to the terminals, to the stations, and we don't have those lines in the United States, and we won't.